Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you the strategy of the week update here for September 22nd, 2022. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my opinion and not a direct trade recommendation. If you're joining me in the weekly webinar, in the Zoom meeting, thank you for joining me. If you are joining me here on Facebook Live or on Facebook, do feel free to sign up for this weekly webinar. I'm taking it live this week only, but next week this webinar is closed. I do strategy of the days throughout the week, but haven't done one here in a week or so, but hasn't been much to talk about with markets going sideways, but we'll talk more about that in a minute. But do sign up for either our strategy of the week webinar in the sign up or in the in the information or comment section of this video, or to get our Zaner Daily newsletter, both available for free with those sign-up links. Well, it's been a roller coaster of a week since WASD came out, surprising the market with really a bigger move for corn there on the reduction of yields than for beans. But what can you do? A bigger reduction there for the beans than it was expected for the corn. Either way, market here kind of failing to break above $15 for beans, failing to break above $7 for corn is the kind of been the name of the game. Today was inside price action for corn. Beans did make a lower low, but generally speaking, we're still inside the range we've been in for the last 2 weeks. Wheat leading the way in its own chart and heading higher. So let's actually begin the day, talking about wheat right now, because there's not much, I hate to say it, but not much has changed since last week, and for corn and beans here. So let's take a look at the daily charts for the wheat contract. Chicago December wheat here is trading into overbought RSI territory, but a nice rounding bottom that we've been talking about for a long time here has finally really come to fruition. We're trading back up to that last big sell-off that we had from the 955 area in the December contract. Trading back up into, trying to get back to that resistance here on a daily chart, in my opinion. We're trading into the 200-day moving average here today, which came in at 915. The 100-day moving average above that at 936. The 55-day moving average well below us now at 824, going to be considered supportive on this chart now. And the 18-day moving average at 849 and being dragged up higher. The short-term daily trend indicator, which while above, keeps the the trend open higher for Chicago wheat at this time. I, however, have been advocating that if we're going to be buyers in the wheat, it should be in that KC hard red winter contract also into 1.0 overbought conditions right now for that KC contract in the December 200-day moving average up at 970 area, 100-day above us at $10. That's where I think we're heading to test next. And the 887 55-day moving average well below us now supportive again if we come down to test it, but I don't think we'll be going down to those levels anytime soon. And that 18-day moving average now at 920 rising up above us and forming that good daily intraday trend indicator. That's this KC the KC contract, from a shorter time frame perspective, on the 4-hour time frame that is, has been channeling nicely higher, but now has been threatening to break out of that channel to the upside right now. Very choppy, but still, a series of longs higher. There's that full 50% long off of lows from the 810 low up to the 921 high. That was basically a pullback from the lows of July to the highs of July there to start the month of September at 864. The market traded up to the 947 target, next in series targets, pulled into a 50, arguably 61.8 line, and have now traded up to its target. I am looking at this though as more of an extended long now, and the market having blown through targets has already traded one extension long, so same anchor, new high now from the 921 area up to new highs. Look for 960 support on the KC wheat. Full 50% pullbacks could take you as low as $9 in a test of that threshold, but I mean at this point in time, we're looking for continuation higher and these trend lines against the lows to continue to hold. My favor for KC over Chicago, though, doesn't come from just what we see on this chart, that chart of KC wheat. It actually comes from the KC Chicago protein spread here. We've got a 4-hour chart up. We've been tracking this spread for the last several months. We've been basically buyers on dips down towards the 50 to 60 area on this chart, as and looking for a broader breakout higher towards a dollar, to $1.50 over. If we get into very bullish wheat markets, we may see that kind of happen. But at this point in time, we at least find ourselves, I think, in a range between 85 cents over and 55 cents over. So these pullbacks down to 60 cents, I'm a buyer down here. I'm a seller on a move back towards 80. If you buy 2 down here, be a seller of 1 up here, hang on to 1 to maybe, to ride out for the breakout higher kind of thing. But at this time, the KC Chicago wheat spread hanging, 60 to 80 cents over, keeps me in favor of buying, being a buyer in the KC wheat. And if I'm going to sell wheat, I'd rather sell it in Chicago. So as long as this spread continues to be bull spread, my game plan in wheat is to, any long KC positions, when it comes time to get out, book profits, what have you, I want to be selling Chicago against it. Until we break below that 55 cents under or over area. That's my game plan. Minneapolis spring wheat, just to give it a shout out here, we still haven't tested its 200-day up at 10.10. So, oh boy, the other 2 wheat contracts at their 200-day moving averages without the Minneapolis contract there leads me to believe that maybe it's going to want to go test that threshold too. So push higher towards 10.10 in the near term would likely drag our other wheat higher as well, with the Minneapolis spring wheat leading the way today, up 13.5 cents. All right, so let's jump right into, I guess, corn. Why not go from wheat to corn? Right now, daily chart of corn up. We are above all notable moving averages right now in a pretty steep uptrend, governed by a channel trend line, and of course this 18-day moving average now at 679, and below the lows of today, being a good line in the sand, while bullish above, bearish below for this current trend. 100-day moving average at 666 and a half. A 200-day just below that at 642 and a half. And the 55-day moving average, the furthest on this chart, at 634. On the near term, or in the near term, and on a 4-hour chart, corn seems to be, there we go, in kind of an ascending wedge or triangle. Resistance is being formed by this downward sloping trend line against the highs of this contract. Also probably the cluster of lows that we had formed at 720 through 780 there back in May, that was holding the market up, that once we broke below, this is our first time back up to test broken support, now is resistance. But also the support being held by both the Fibonacci trends and different trend indicators that we have trailing us higher, as well as trendline support and channel support for a market that's otherwise been trending higher. Open gap above at 730 and a half. Open gaps below at 628 and 650 or 584 leave this market with some cleanup to be done on both sides of the book. The support at this time down around 670. Certainly, while we're above 680 in the very, very near term. Next support below, in line in sand is at 660. And below 660, I do think we run the risk of then trading all the way down to fill both of these gaps here at 630 and 584 respectively. But that remains to be seen, as corn's been in an uptrend since late July. And this 4-hour chart, if it wants to, and we break out $7, that's the threshold. That's the line in the sand for me, that if we break above it, okay, 730 next, and we get above that, now we've got momentum. We could go higher. I think corn has ultimately ran the risk of not having other things alongside it, like soybeans and beans might follow suit, but things like oil and the equity indices that have been under pressure lately, and of course the very, very strong dollar. And that strong dollar is where we'll take the discussion next, and we'll come back to our row crops and soybeans here in a minute. But the dollar index, one of the biggest bull markets in history, and certainly in my lifetime for the dollar, taking it to its highest levels in my lifetime, and certainly for the last, and many of our viewers' lifetimes as well. 111 here on the dollar index, and without any kind of signs of stopping, other than we're just very overbought at this point in the dollar. So every time we tend to get overbought in currencies, we do see periods of retracement and pullbacks happen, but it's not a reason to pick a top at this time. But any kind of weakness that we would see in the dollar would probably have to come after this incredible strength we've seen in the bonds lately, where the weakness and the sell-off we've seen in a flight to quality into the U.S. dollar in this risk-off scenario that we've been witnessing globally is not just a phenomenon that the U.S. is going to be privy to now. For the last year and a half, 2 years, it's been a systematic U.S. rate rising environment, while the rest of the world has remained in relative quantitative easing type of mentality. That's resulted in a very strong dollar and very weak other global currencies. Now we're hearing the winds of 16 or 17 central banks that have all started hiking rates as well. That's probably also a precursor to the end of this global dominance of U.S. dollar strength, because other currencies are going to start to garnish other positive carry. If you can get 8% if you can get 8% for lending money out in Australia, and you can borrow in the United States at 5%, you can make 3% just for taking U.S. dollars, converting them to Australian dollars, and lending them out in Australia for basically 3% risk-free return. That is the type of carry trade that will correct the U.S. dollar strength at this time, and you'll start to see the U.S. dollars find their way abroad, purchasing foreign currencies to try to earn higher rates of return. And particularly if you see the U.S. Fed start to walk back on their rate rising policy, I think we'd have to probably go well below a half a basis point rate hike at this point to see some dollar strength just from the Fed alone, or come off some dollar weakness from the Fed alone. But nevertheless, export numbers later this year will be faced with a stronger U.S. dollar than we've seen in the last couple decades, or export markets, I should say. And the figures that come from those markets will potentially have had to run into some trade headwinds because of the strong dollar. So we'll see. But keeping an eye on those export markets in the fourth quarter this year will be a tell as to how committed our foreign export partners like China are to getting the commodities they need. They may not even care what the value of the dollar is when the value of having the commodity in your silo or in your supply chain is far greater. So, all right, let's move into soybeans here. November beans, 1457, bit of a dip here today. Lower lows and lower highs for the first day here in a week. Hasn't exactly been an uptrend since just basically 3 days of straight up after the Wazir announcement. And we find ourselves basically trapped below $15 and above 14, and kind of right in the middle of that range. When you really get down to it at the end of the day here. So I think the market is gearing up for a move either above 1490, push above 1500, or for that break back below 1440 at this point, which arguably today we really started to test that threshold of, for a move back down to the low end of the range we've been in for the last 2 months, which would take us down to mid 13s or $14 and the just back to the 55-day moving average, for example. Anyway, 200-day moving average at 1422, 100-day at 1447, 55 at 1409, with that 18-day moving average, which has been kind of the reversion to the mean for the last several months, but 1437 there on the soybeans. We are holding above it. We slide below it, I think we head back down to the low end of the range, and like corn, we find ourselves holding above levels that below could find a slippery slope. Again, a push above highs though with momentum could be a substantial breakout. We have, what's this now, our third month of building up stops for potential short sellers above $15 in soybeans. That could be some fuel for the fire and for a move higher. On the 4-hour chart for November beans, open gap above at 1540 or 1534, has been there since the late summer, midsummer, I guess, since June. Gap below is down to 1350, also the lower end of support on this chart. We've been trading sideways in a range for the last 2 months and find ourselves generally inside of that range, but yes, towards the upper third. Could we be breaking out of trend lines and having broken out of them on the WASD report day, now trailing back and pairing against them as buying as support? Maybe. Have we pulled 50% back for the month from lows in the month at 1373 to highs 1508? 1440 was a 50% retracement. So yeah, if the market can find some support here and push through highs through 15, opens the door to 1534 to 1585, both fib upside targets as well as, hey, an open gap and our prior contract highs. But we slipped back below 1440. We're just back into the old muck we were in, and we're going sideways in range. We slide all the way back down to 1360. A couple weeks from now, we might be, or maybe even early as next week, we might be, if it were to actually happen, that is, we might be talking about the threat of the market breaking down. And on that larger time frame, if we start to break down out of this range, how far down can we go? Well, we've traded to 1288 this year, just this last summer. If we threaten to trade down to those lows again, now we're talking about lows of the year, and that's where the slide down towards 12 or below could occur. Not calling for that, but you could see how technically we could get there on the chart, and without any other change in fundamentals. I think that's a little hard pressed to believe that would occur, but you can't underestimate what the paper price on the board can do in short notice. Okay, let's move on and take a look. Shifting gears now to energy markets. Let's take a look at that daily chart for crude oil. We've been watching a what we're deeming as a very large corrective pattern that began from the highs of the year. Ever since we pulled back from 130, crude's been correcting in some kind of larger pennant, three-wave structure. Could it be coming to a close? The 86 area was that first equal leg supportive area that we were wanting to hold. We're open, in terms of how far down it can dip, down to 77. So we're definitely into that supportive threshold. We're into the trendline support. If you draw against the daily, all the lows on this chart, we're down into that trendline supportive area, which is between 90 and 83. So we're at actually one of the lower bounds of a trendline here. A channel supportive trendline at this point in time in crude comes in around 80. So lots of reasons to think we could be nearing that end. The failure for this market to just completely break down altogether certainly gives it some supportive qualities, or a reason to think that support is trying to be found. But the big threshold that I think we're holding above here that's important is this $70 to $83 area, which were the cluster of highs in 2021 through 2022, or in all of 2021 that we found as resistance, that we broke through at the start of 2022. We've come back down to now test as support. So if the market can hold around this area, again, we need to see some proven, reversals, some breaking through resistance trend lines, some just how about a couple days off of lows of higher highs and higher lows, things like of that nature to advocate coming in and being a buyer again. But we are at least still into that area where, hey, if we find a reversal pattern that we like on crude from here, this could just be a very large correction in the midst of a much, much larger uptrend. I'm not going to say we are going to $200 crude, but why couldn't we? I saw crude go negative last year in the front month delivered contract. So I think there's just as much probability of crude going to 200 again as there is if it going down to $10 at this point. So let's at least keep that perspective on that type of idea as well. But a move back towards 100, towards 115 or 130, that's not so far-fetched. And this very choppy correction and start off the highs that we have is anything but a very clear cut reversal and trend at this, in my opinion, on a daily or weekly time frame at this point. That could all change, breaking below 80, sliding lower. Markets move, and it's an ever-changing landscape, but it is what it is. Okay, so in our meat markets now, live cattle here kind of lagging the feeders, with the feeders having fallen 1.25 points today. and getting ahead of myself, but here's that head and shoulders pattern in that October feeder cattle that we had been watching here for the last several weeks. Finally started to break below 180. Reversal on this type of pattern could take us all the way down to 170. And notice how the last week we've been pretty bearish on the feeders. 4 days down here with the live cattle only now, having topped and now traded its only second day lower. Feeders, hopefully being the leader, are maybe signaling for that reversal in the live cattle as well. So October live cattle here on the 4-hour charts. Breaking below that short-term trend line here that we are holding higher for the month of September. In my opinion, opens the door for that retest of certainly 144, but back down to 142. And certainly back below 142, I think is now a correction against this larger uptrend that have been watching, but a very corrective one that has lost momentum and struggled with every push higher at this point. So if the market starts to roll over as it has, you look for these pullbacks, right? Are they reasons to be a buyer? Perhaps, but at this point, I would have expected us to break out. I would have expected, demand to have justified higher beef prices and a move above 150, and I'm just not seeing it yet. With feeders now falling back, with even lean hogs maybe falling off of their highs, I think that we're starting to see an exhaustion pattern here, and maybe even an ending diagonal structure, dare I say, an ending diagonal structure that could be capitulating and completing here in the live cattle. And if that's the case, we might be due for a flush out all the way down to like 136, and I'm just not willing to say that just yet. But I do think this reversal opens the door down to 142. And I'm personally, I think, looking to for a reason to now be a seller intraday in the cattle into a position that I could potentially make a swing lower towards 136 or below. Maybe put spreads at this time are probably the more advantageous trade to be looking at, but we will see. All right, and so last but not least here, the S&P 500. Not really much in the way of larger trend levels to speak of at where we're at right now. We've broken below trendline supports. We are holding trendline resistances. Full 50% retracements off the high here seem to have held, right, even though they kind of went up and tagged 618 lines. So that 4100 short down to its target has traded. So I guess next to the series, look for 950 as resistance on the way back up if it ever tries to trade back up there. But at this point in time, this daily chart, it's looking at those levels is a little muted in my opinion. This 15-minute chart, though, on the day the market pulled, it looks like from the highs and lows of the day, it tried there just a moments ago to rally and got rejected into its 50% retracement for the day. So look out below. If the E-mini S&P continues lower here, 37.47 downside target here from this recent 50% rally here intraday. But I don't know. We've seen some strength here this afternoon. Might be enough to get this market going, but we'll see. All right. Well, it's certainly not a reason, I think, for a major reversal to happen. But hey, when all is said and done, there's plenty of support, resistance levels that this market could go up and test. Including up to 39.70 if you wanted to get there, really. And of course, now downward sloping trend lines against the highs that we have been holding, maybe you could say channeling in for the last couple days. Certainly move back up to 3900 as resistance wouldn't be off the table either. Well, that wraps up today's strategy of the week. Thank you for joining me, everybody. Not much to do when we are caught, generally speaking, inside of many ranges on markets. More levels to watch, because then we've got active things to take part on and be a part of. Obviously, crude might be finding some major supportive areas. The meats, we looked at feeders and live, could be rolling over there. Wheat, we like wheat here, and we think we're going to see some better support here in the future. But if corn and beans can't also hang on to their support, we might see reasons to be sellers here, but nothing to do just yet, right? So with all that being said, have a great day, everybody. We'll be back with you as price action develops. You can always reach me over here at Zaner at 312-277-0110. You can find me on Twitter. Shoot me a message on Facebook at Dan SOTD, or shoot me an email, dhussey@zaner.com. Thanks for joining me, everybody. Sign up for the free Strategy of the Week webinar or a free daily Zaner Daily newsletter in the comment sections of this video or in the information section accordingly. Have a great day, everybody, and we'll be back with you as price action develops.